Welcome to episode 7 of the Tax Smart Daily. I'm Brandon Hall, coming to you from Boulder, Colorado on my partner retreat for our firm. Before we get started, check out the links in the description to this video to join the Tax Smart Real Estate Investor Facebook group and the Tax Smart newsletter. It's a weekly newsletter that we're launching to help keep everybody up to date on especially the changing regulations that are coming out with the Biden administration. Also, if anything in this video resonates with you, or if you have any questions, drop me a comment, leave a timestamp. I love interacting with the community, so please let me know what you liked about the video, or if you have any questions, let me know. Today's topic is going to be depreciation recapture. What is depreciation recapture? Well, it's important to understand that depreciation is kind of a loan from the IRS. Like that's the way to think about it, right? So we depreciate our buildings over time, our rental real estate over time, and it's meant to track the deterioration of the asset over time, which is why we depreciate. Even though real estate appreciates, we depreciate. And I talked about depreciation on one of the earlier videos in the Tax Smart series, so go check that out. But the problem is that when we sell our rental real estate, we have to pay a tax on the depreciation that we've claimed, and that is called depreciation recapture. So depreciation is not free. Any depreciation that I'm claiming, I have to pay a tax on at some later point. I don't have the option to not claim depreciation because it is required. So whenever I sell the asset, the IRS will assess a tax, that depreciation recapture tax. It will be assessed on the depreciation that you have claimed or the depreciation that you could have claimed. So you have to claim depreciation, but you also have to pay a tax whenever you sell that asset on the back end. Now there's three types of recapture. There's Section 1245 recapture, there's Section 1250 recapture, and then there's unrecaptured 1250 gain. So Section 1245 recapture is taxed at our ordinary tax rates on all the depreciation that you've claimed allocable to your Section 1245 property. Now, what is Section 1245 property? That's my personal property. So think 5 and 7 year property. When I do a cost segregation study, I'm reallocating value away from the building, and I'm allocating it to 5, 7, and 15 year property so that I can claim bonus depreciation. You can claim bonus depreciation on any asset with a useful life of less than 20 years. So after this cost segregation study is performed, I will have value allocated to my 5 and 7 year property, and I can claim 100% bonus depreciation on it. The problem is whenever I sell the asset on the back end, I have to pay a tax on the 1245 depreciation that I've claimed, and that tax is equal to the total depreciation times my marginal tax rate. So up to 37% with today's marginal tax rate. So it could be a really high tax on the depreciation that I've claimed relative to my 5 and 7 year property. That's called my Section 1245 property. I also have Section 1250 recapture. Now Section 1250 recapture refers to the recapture or the bonus that is in excess of straight line. So what we're talking about here specifically is our 15-year land improvements. So when I do a cost segregation study, I allocate value to 5, 7, and 15-year property. And the 15-year property is all my land improvements. But I can bonus depreciate my land improvements. So Section 1250 recapture is specifically any depreciation that is in excess of straight line. So let's say that I have a $15,000 parking lot, $15,000 land improvement. I depreciate that $15,000 over 15 years if it's straight line. So if I then sell my asset 5 years later, I should have claimed $5,000 of depreciation over a straight line basis, right? So $15,000 value divided by 15 years, $1,000 a year. I sell the building 5 years later, then I should have accumulated at that point $5,000 of straight line depreciation. The problem occurs the recapture occurs when I bonus depreciate that $15,000 thanks to the cost segregation study. So instead of doing any sort of straight line or 150 double declining balance, which is a different depreciation method we're not going to get into, instead of doing any of that, I just claim the entire $15,000 in the first year of ownership, or in the first year that it's placed in service, thanks to bonus depreciation. So when I sell it 5 years from now, I claimed $15,000 over a straight line basis. I should have claimed 5 because we held it for 5 years and we sold it. So that means that the variance is $10,000. That's the excess over straight line that I have to recapture at my ordinary tax rate. So again, as high as 37%. And that is Section 1250 recapture. So we've talked about Section 1245 recapture. We've talked about Section 1250 recapture. The last one is unrecaptured 1250 gain. That's depreciation related to my building. and that is recaptured at a maximum 25% tax rate. It scales up with your income scaling up. So it's a maximum 25% tax rate. So on the back end, well, before I explain that, just to wrap up unrecaptured 1250 gain, any depreciation, you know, this is my 27.5-year property, so my building, any depreciation that I've claimed, I will recapture at a maximum 25%. And it's just as simple as adding up all the depreciation and figuring out what rate I use with that maximum 25%. So that's unrecaptured 1250 gain. So you got 3 buckets: Section 1245, Section 1250, and unrecaptured 1250 gain. So what's the strategy? Well, the strategy is, in general, you want to run a cost segregation study. You want to bonus depreciate everything and take it up front, because you're arbitraging the tax value that you're getting up front, the tax benefit that you're getting, and just from the tax savings of running that depreciation, getting that huge depreciation, that increased tax loss, you get the tax savings as a result. But you got to pay them back at some later point. So how do you avoid this huge recapture tax? Well, there's a couple ways. First, you can do a 1031 exchange, assuming that holds up with the Biden administration. So you can always 1031 any depreciation gain, any gain related to depreciation. You can 1031, you can roll forward. Another way to do it is to buy new property and bonus depreciate that. So you cost seg, bonus depreciate, you create a big loss on your new property that offsets some or all of the gain from the property that you are selling. People here like motorcycles. You sell all or part of the gain, so you can cover with the tax loss from the new property some or all of the gain from the property that you're selling. So that's way number 2. So you can 1031, you can buy a new property. Third way that you could do it is you could just sell the property and get another valuation performed. And what you want to do on the back end, if the gain's large enough, you get another valuation performed that moves value away from the 1245 asset and into the 1250 asset, the building. Now, what do I mean by that? Well, if I put new carpet in when I bought the property, and then over the span of 7 years, I never replaced the carpet, but then I sell it in year 7, maybe the carpet cost me $5,000 when I bought the property, but when I sell it in year 7, the carpet's not going to be worth $5,000, right? It might be worth $1,000. So when I sell, I can make that adjustment and I can allocate value away from my 1245, 1250 assets and into my 1250, my building, and I could potentially save money on the recapture there. So I hope that this was helpful. If you have any questions, please jump into the comments. I would love to interact with you. And check out all the links in the description to this video to interact with our community, join our community. We'd love to have you.